All right, here we go. So edge zones, real-time support resistance. Before we get too far or too carried away, let me give you guys an example of this. I do this in front of all my webinars, the why. If you know how, you'll have a job. That's me, by the way. It's my dad right here. He always told us, my family and I, in the middle, if you know how, you have a job. If you know why, you'll be the boss. Today we're going to talk about what's going to help you know when to buy and sell. Order flow and correlations, market relationships, they are the why to trading. If you didn't watch any of my webinars, you think maybe they're all the same, but I like to start things off that way because it's a missing piece to what a lot of people don't understand, and that's why. Hopefully, we'll get a little closer every time we meet. There's me, not too long ago. A lot of people think that that's a ton. It's not long ago, about 5 years ago. But I'm showing this because this is how I'm going to do my bio. I was a CME clerk, then I was a board of trade, floor trader, was ready to quit because I couldn't make any money in 1999. And I found out that there was this thing called a prop firm where a bunch of traders worked in an office, traded electronically, European futures at the time. And that's all it was, a bunch of guys in an office. We traded on a screen. And their deal was, if they hired you, they backed you, and it was a percentage split. Trader gets half, the house gets half. 3-year contract, 50-50. So I went from the floor to the screen, went from failing, ready to quit, leave the business, to making more money than my dad, and I was home by 11 o'clock. What do I mean by that? When I got introduced to a prop firm, didn't know what it was, risk manager brings me in and he says, hey, this is our layout. And it was like noon. I said, well, where is everybody? He says, well, we start at, or we finish around 10:30 in the morning because Europe is closed then. They were just trading European futures back in 2000. He says, but I can't hire you. You got to meet the owner next week, and if he likes you, he'll bring you on. And I'm like, wow, what time do they start? 1 in the morning? He says, no, we start about 6 or 7. And 4 hours, they're gone. So that's the firm. I asked my dad when I go home. I was still living at home. I was in my early, mid-20s. He goes, go early and see the cars in the parking lot. If the cars are nice, take the job. So I did that. I got there before 10:30, seen nice cars in the parking lot, met the owner, who was a floor trader himself. And he said, what makes you think you're going to make money? And I said, well, because I'm putting myself around other guys that are doing it. And he says, you got the job. It was the last question. What makes you think you're going to make money at this? And I tell this story a lot. I think it's important because while it was the right answer, I didn't think about it real long. It was just a kind of, I guessed at it and got it right. If I put myself around other people, I'm giving myself the best chance. And he says, that's what I want to hear. Didn't check my references, hired me, and said, start when you want. But the point of that is, he also elaborated and said, it's not just being around people doing it, it's also being around people that are driven to do it. He says, if you're just around people doing it, you get intimidated, maybe jealous. But if you're around both, then you're able to be ahead of some, below some, and really strive to work to get better and better. So that's my bio in 2 minutes or less. There's a couple extra guys that put yourself around. So let's roll into today's content. And that's these edge zones, the when, the how, the why, the when, the how. Here's 2 important things that I want you to get from this event today. Why do they show stock traders, and when can they tell you to trade? In other words, why would they work support and resistance, no matter how you get it? Could be this way, could be your way. And when could they tell you to trade? Pull the trigger, execute, stop missing. Those 2 things I want you to come out of this webinar with a better understanding. And I'll tell stories that some of you are familiar hearing, and it doesn't hurt to hear again to kind of make it memorable. Some of the things that you also come away with, what the hell are these? Acronym is EASY, edge zones. Why do they call real-time support resistance? When do they show up? When will they disappear? When do they change? Real simple stuff. So the last part is how to use it in multiple chart types. Whether it's a footprint, you could use them. Now it's Sierra Ninja, you could use them on bars or candles. You don't have to have them on a footprint. All right, so let's get rolling here. And again, you guys ask questions, fire them in. I'll answer them during the session or at the end, but I will not ignore them. Imbalances and thin spots. That's what we used to just have until I developed these edge zones for originally Market Delta and then Sierra and now Ninja. An imbalance was the original locator. Thin spots was where the tempo picked up, and I'll get into that in a second. But why to use it And the key to this is this saying that I always try to say in every webinar that I do. After you buy it, you're a seller. Just kind of remember that as we go along this event. But let's get rid of these and pull up an actual dome. Even if you don't use a dome, I want you to understand something from this image. When you see a footprint, if you don't know how to read it, it'll overwhelm you with a bunch of numbers. Jim, I'll get into that in a second. It'll just overwhelm you with a bunch of numbers. What these edge zones do or anything like it will create an easier way to read it so you don't have to worry about all these numbers. But where do they come from? I think if you don't know this, then it's like the rest is irrelevant. So in just a couple minutes, I want to show you how these numbers, which is the footprint, would come to be alongside a dome. All right, let me pull my pen into this. So we could, I left a couple spots open when I took this image a long time ago. You can see, look at the price in the ES, 27. Obviously, this was an image from 2 years ago, probably. But either way, the footprint is here on the right. You can see how it's red, red, red. You have to assume a couple things. In any chart, whether it's a footprint or a bar, direction. You know, where did it start, and has it got a directional movement to it? Or in other words, rotation. So if you can assume this is a bar that's heading south and the price is heading south, when you see it get thin, you know, say thin spot or imbalances, it's because why? Because price is going down fast. And that's what's not allowing a lot to trade on the other side. What do you mean the other side, Anthony? Well, if you take a footprint, you know, and I do other webinars that just focus on this slide alone and really get into it. So I'm going to kind of speed through it. Some of you guys already know this, some don't. I think it's important to at least go through it like I'm going to do. If you take and you split the footprint in half, and you look at the numbers that are diagonally related, and I'm sorry if you can't read, but what the actual number is less important. The fact that the relationship in this diagonal relationship has an imbalance that's big enough to make it red. All right, what does that mean? How do we know? Where do these numbers come from? Again, splitting the footprint in half, the numbers on the left indicate people who aggressively hit the bid or aggressively put in a sell market order. That's all. So if you could think of the footprint as market orders on the left-hand side of it, sell market orders on the left-hand side, and sell buy orders on the right. In other words, when you trade and you put in a buy market order to try to buy, in this case, let's say 5 even, you wanted to buy it, you would lift that one lot, with all things being equal, it would go away, and you'd show up maybe right here. It'd be a number 1 on the right-hand side of the footprint. Are we with each other? And I'm not trying to be too simplistic, but I don't want to spend too much time with this. It's just important to know where the numbers come from. Well, let's just fill in these. Let's say there's a 3 lot on the bid and there's a 4 lot on the offer. That means that the price 4.5, 3 people or 3 contracts wants to buy it, and 4 contracts want to sell it at $4.75. If someone comes in and buys 4, they're going to show up on the right side of the footprint corresponding to the price, and it'd be number 4 if it was in one swipe. And it goes up accordingly. Someone else comes in and offers 10, and they buy that with a buy market order. This would look like 14, and so on. And then if they come in here and they hit this 3 with a sell market order, this number would go up by 3. And if there happens to ever be an imbalance in that relationship, it would show red if it's an imbalance. People hitting it and selling it fast, then they're buying it. If the market's getting sold fast aggressively, then it is getting bought fast. It's going to have a red imbalance. That has to make sense to you. The reason why it's 0 here is because when the market went from bid to offer, it went so fast nobody had a chance to go and buy the offer because it got driven back in the book. Market went down. So that much has to make some sense to you. The whole point of this slide coming out of it is when you see a lot of red strip or imbalance, you could accurately assume the price fell fast. Tempo is important. And I'll get into why tempo is important and why it creates these edge zones. Green if it goes up fast, red if it goes down fast. So it's a better visual. 5 or 6 years ago, the imbalances were created to give you a better visual. And then a couple years ago, these edge zones were just simply to throw red lines across when you got the imbalance to show you, hey, the speed picked up and went down fast. And let's be simple. We'll get into why that's important in a second. Let's go to a picture when you're buying and selling a car. What does that mean? Let's just take a funnel and turn it upside down. And stay with me on this one. These guys are buyers and cars are sellers. If there's a bunch of buyers down in here, but there's a lot of sellers, ooh, the car went. And there's a lot of sellers here, the market's probably just going to chop around because buyers and sellers are close. They're going to interact with each other. Price isn't going to go anywhere. If the sellers leave and start to get picked off and the inventory leaves, but yet there's still more buyers and they got to find the sellers, take a look on top of this funnel. That's where the next layer of sellers are, and the buyers are still here. All of a sudden, if there's a lot more buyers, they got to chase up the neck of the funnel. And it creates a thin spot. Think about that, just like that footprint showed you. Price went up faster because there was a motion of a lot of buyers, and they had to find where the sellers were, where they were selling inventory. So every number you see on a footprint, just think, on the right of that little X are aggressive buyers with market orders. On the left-hand side are aggressive sell market orders. What you would see here on a footprint is a lot of green imbalances at each price level because there was a lot of quick buying and not selling, and price went up. That's what should happen when there's a lot of buying quickly and no selling. Price should go up, right? In any market for anything. Hopefully this image and this story make a little sense to you, because that's where this green line starts to come in, where it gets thin, where the tempo picks up. Why is it important to know where the tempo picks up? And let me stay on this slide for a second. I don't have any pictures for it. Just stay with me on this. If anything moves fast, there's always an instance where a lot of people are going to miss it. If a guy runs past you real fast and you're asked, what did he have on? How tall was he? What did he look like? If he walked by you, you probably have a chance to answer those questions. If he ran by you, you missed something. More people miss things that move fast. So if price, in that example, goes up fast, did more people miss buying or selling? They missed buying. They didn't miss selling because they could sell it at a higher price. Good for them. If it moves fast in here, then the in here is where people missed doing something. And in this case, they missed buying. Now, I don't know about you, but when I miss something, I get anxious, especially if I'm short and I got to buy it. Remember that quote, after you buy it, you're a seller. After you sell it, you're a buyer? If you sold it and you're short, and I'm assuming those people in here trade futures, so you know what getting short means. What happens when you're short? You're now a buyer, correct? To cover that short position, you might do it in an hour, you might do it in a day, you might do it in a week, but at some point you got to cover a short position, right? A lot of people are short. There are a lot of buyers in the market. If a lot of buyers missed price, why? Because it moved up fast. There's probably good subsequent support down in here, and that's a big part of what these edge zones are trying to create better visuals for. There's no holy grail. There's just a better way to look at the same thing. You got to know what the right stuff is to look for. And in part, this is reading order flow. You got to know what it means. Then you got to have the best visual to see it. And then we work into executing it and pulling the trigger so you miss less. Nobody would argue that knows anything about trading, that knows anything about valuing the price of anything, the concept of when price moves up fast, you get a lot of anxious people who miss buying it. The tempo goes up fast with imbalances or these edge zones. You got people probably sitting down in here wish they would have bought it. I'm going to tell my baby bird story. I've told it a million times. I'm going to tell it. Maybe some people heard it and want to hear it again. Here's another story that I'm going to tell. And I didn't do images for this because I'll probably get in trouble. But in my single days, if I was at a bar and I'm sitting at the bar there and there's a pretty young woman there and I buy her a drink and I'm thinking to myself, okay, I bought her a drink. Now I'm going to go talk to her. I'm going to go talk to her. I should go talk to her. Let me go talk to her. And then she gets up and leaves. Now I'm mad. Now I'm anxious. If she comes back, I'm going to try to talk to her. If I get another opportunity, you're going to be anxious to try to talk to her because, again, when you miss something, you start to regret, you start to get emotional. So if she came back, then I talked to her, then she'd get back up and probably leave again. The point is, when you miss things, you get emotional, you get anxious, and you want to put yourself in a position to recognize when other people are doing it. This webinar and all the webinars I do and all the stuff that I have is all about, forget about if you're long or short, worry about the rest. Start reading the market by reading other people's positions. Trying to grasp if the market is too long or too short. Trying to grasp if the market is got some stuck shorts that would create a lot of buyers at this area. If you're stuck short, SS, I'll call it right here, then you're a buyer. That's just you. Now, if there's a lot of buyers that are stuck short, this is what they look like. They're all still having to buy it, and they might have to race the market up. Again, where's support? Where do most of them miss buying it? Are we with each other so far? Now, baby bird story. I don't know why I threw a car in the middle there. That's interesting. I forget how that fit in the story. All right, baby bird story. And remember this I put on the agenda page. Why do they show stuck traders? That's what's important about good support resistance. The reason why it's real-time support resistance is because they keep updating through the session. How many people have support resistance from days ago, from just hours ago, weeks ago? And there's nothing wrong with that. But how many people that have them to update, and I'm not saying it's the only stuff that updates during the day, but I'm saying real-time support resistance, it's updating what guys are doing, what they're missing, and when something doesn't happen. So the baby bird story is just stuck shorts that are desperately looking to buy it but feel helpless. Just like baby birds in a nest, they can't survive without mommy bird to feed them. And mommy bird's price in this funny little metaphor. Price is coming down to feed the helpless buyers, and the hawk comes in. And the hawk rips mommy's head off, takes her away, and the baby birds are stuck with no fill. Still short. Still stuck. I've always was asked, how do you finish the story? Baby birds fall out the tree and get run over by a car. That's them blowing their account out if they really can't get out. Stuck traders. It's like helpless baby birds. Next story fits this line. When can they tell you to trade? So we get an idea where these red and green lines come from. I'm going to show you on real charts in a second. But why could they, or when could they tell you to pull the damn trigger? Because I guarantee you, all the years I've been in this business, April 2000, I started trading electronically. April of this year will be my 20th year. About 6 or 7 years, I backed into education and spoke to thousands of traders and enjoyed every minute of learning about what people go through as retail traders. The people have been doing it for a long time, did this, did that. And what I've learned to be a common denominator of a pain point or weakness is when to pull the trigger. Yeah, there's problems with risk, and that takes them, only 2 days to lose 2 months of profit. But missing trades, it gets down into your area, and all of a sudden, it bounces, but you didn't buy it there. You missed it by a tick or two, or you didn't even try, and it worked. Comes back down to your area, you miss it, it rallies. Damn it. Comes back down, I'm not going to miss it this time, and sure you don't miss it, and it goes right through you. That's a common pain point. Do you guys agree? You miss a lot of good trades, catch a lot of bad trades. Might miss a trade by a few ticks, and people call it front running. It ain't front running, it's you're just stuck there with too many other people. You can't just leave an order in the book at a good level and think life is good. That's like playing on the railroad tracks, hoping the train stops. When the price comes down, it's like, it's going to stop at my price. That's too much vulnerability. Too much vulnerability down there. So the point is, how do you qualify? How do you have some skill to see when they could tell you to trade? And one of the things is when something happens that should make the market go down, it doesn't. Another thing happens to make it go down, it doesn't, and then bam, it goes up. Don't you think you should know that whatever happened in this circle that should have made it go down wasn't? The tell, the clue, the card player that sees the guy when he's bluffing, the detective that knows he's got the right suspect because he's got him lying. You got to know what the tells are. Punch a guy in the face is what this picture is about. If I punch a guy in the face and he doesn't flinch, I ain't that tough. I'm running the other way. My younger years, I used to stay and get my ass kicked. I'm smart now. If I punch a guy and he doesn't flinch, I'm running the other way. When does that happen? And I got a little cute picture of a guy running the other way. When does that happen in the market? What does that mean in trading? Well, what should happen in this circle to make price go down? Selling. What if you've seen a lot of selling, the market punching price in the face and it doesn't flinch? A lot of selling should get the price of anything go down. Right? Oh, I stopped punching guys in the face. I'm done. Especially if they're not flinching, then there's a problem. So good tip, Kyle. Although I would like to do that as a live example with one of the guys that's been with me a long time. I wanted to see how that all would go down, but I'm afraid he really might not flinch. A lot of selling comes in. The price of anything should go down. Everything should go down or should have a little downside reaction to aggressive selling. And again, look at the footprint. Think of the footprint. What would the footprint look like? It would have a lot of red compared to nothing on the bid side. No aggressive buyers, a lot of aggressive sellers. Price should drift lower, should go lower, should spike lower. If it doesn't, that's a potential tell of this punch a guy in the face and doesn't flinch. It's called absorption. It's called absorption. People look at it reading Delta and stuff. And so with these edge zones, it's not just real-time support resistance of just that, green for support below, red for resistance above. But when it gets into your area, what's the qualifier to pull the trigger? You got your ready, you got your aim, what's your fire? And a lot of people are weak on fire. When I'm trading like crap, that's because I'm not reading the market well. I'm missing my executions off. And no matter how long you've traded for, no matter how profitable you've been, you always go into a rut. And if you know how to trade and you've got that track record of being successful for so long, you know what to do. You're just weak at it at that particular moment for different reasons. But you know how to do it and you get better. There's so many people that get into this business and they lose a lot of their own money and they never learn to give themselves a chance to qualify a trade. They think that the best indicators out there are the best support resistance, right? Red light, green light. And it's not their fault. You don't know what you don't know, but you get into this business and you want to get, the best, not the best necessarily indicator, but the best support. Look how well this works. Value area low. Every time it comes down to here for a profiler, it's going to bounce. And even if that's the case and you find that, where do you buy it? Do you buy it at that price? Do you buy it a few ticks below it? Do you buy it? Oh, I'm going to buy it a few ticks above it in case they front run me, people say. No, that's not going to work. That's not going to be a consistent long-term strategy. You got to have some skill to know when to punch and to know when to run, to know when the market got punched and can't go, to find the exodus of other people who just sold a bunch and got stuck short maybe, and they're going to lift the lid off of this damn thing. Like I said earlier, start getting better and better this year, learning what other people are thinking, not so much yourself. I know we all like to do breathing exercises and take all kinds of psychological courses to feel better and look better and all this other stuff, and that helps. Start thinking about what other people feel like. Where's their pain? Because it's the emotion that moves markets. Markets go up because there's enough trap shorts that create shorts equals buyers, and buyers that have to buy it and are emotional start to send price up. That's why price goes up. Too many shorts. When it goes up fast, more shorts. It goes down fast, too many people are what? Long. Faster it goes down, the more people were trapped long. All right, so we're with each other there. I'm hoping we are. Let's go to a live chart. Today, by the way. I'm not going to pull up images. Oh, geez, I just removed it. All right, let's do it right here. Let's pull up a couple charts from today. Now, this seems like it's a lot of noise, but you got to take it step by step by step. So a lot of webinars I do that pull out a chart, my eyes fixated one way, and that's the way you got to be able. Today was a crappy range, tight first 5 or 2 hours was what, a 5 or 6 point range in the S&P mini. So there was a lot of that chop. So it seems noisy, but these aren't really a lot of levels. And I want to drill down into what could get you to play the bottom of the range or potential support or resistance as it's happening. Not after the fact stuff. I do a live trading room every day, so there's a lot of people that come to my room daily. We talk about this stuff as it's happening. People are selling it and it can't go down at support. If you got good support, what makes you buy it? One thing could be selling and it can't go down. So right in here, we got the market shot up fast where my cursor is throughout this green level. Market rallied, come back down to it. Number one, I like levels that get drawn out on this particular chart. I'll tell you why they change colors in a second. But first, it goes green to light green to orange. Goes green to light green to orange. We'll get into that in a second. But the market bounced. Be nice to buy it there. Do you think you're going to make a living just by bidding the price of the zone? These are great zones, but nothing is that great or clear. But I'm going to replay what happened on the footprint chart. And by the way, this is taking footprint information and putting it in our bar chart. So you don't have to get overwhelmed with all the numbers. But I put a footprint chart up right here, and we're going to replay it. And I'm going to show you what happens. This is the area around 3-4 even. Just let's play it and watch what happens. First thing is, let me stop it. First thing is, it's going through potential support, but the market's already used this as some support rotationally. It comes in, old red, new green, but there's nothing to qualify buying it here. Let's continue. And I sped it up. Wait, let me stop it again. What happens in here? We showed you the image on the other page. Gets fast, and it gets fast going up or down. Down, obviously. Red, 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 red. All right? And it gets into this support area. Still no qualification. Now let's play it. This is a couple times faster than normal. I don't want to spend all the afternoon with you guys. Oh, look at that. I stopped it. Did you see it go red, red, and the SOB couldn't go down? Let's go back a minute, and let's slow it down. I'll go too fast. Now, there's one red, and it goes down, right? All right, let me slow it down for those that are older. No offense. I'm pretty sure I can't be using that joke because I'm getting older. All right, watch this. Come in and fire out of this hole. Not that, hey, you just got to buy it every time you see it, but the qualification of selling coming in and the damn thing can't go down. There's some selling. I stopped it. Now, do you see the difference between laying a bet down here and you don't get filled and maybe you using some qualification to say above this red is worth taking a shot? I'm not just showing you ones that work. I'm showing you today's examples. All right. So the market gets sellers to come in. They appear. I even got audio for it, but they appear and it can't go down. Punch a guy in the face. So you got support. Well, what do you have support, Anthony? Because the market kicked up and went fast, left some baby birds potentially down here. Traders who are short, they wish they had bought it because the girl went to the washroom. She comes back, sits back down, so they're trying to talk to her the next time. Baby birds are trying to get fed. Sellers come in, which is punching a guy in the face, doesn't flinch, market runs away. All right, that's one example. Let's get rid of this guy for a second, and let's bring in back to this chart. This was, what time? The next time, the 3-4. This area right in here. So it tested and worked once. Is there something in here that could get you to, again, qualify a support level. And it doesn't have to be my support level. It could be yours. I've got this that works in the same concepts, Kyle. Good question for whether it's the NASDAQ and CL. I'll show you those charts in a second. They're up on that screen. And there's a head fake below the VWAP as well. Mark, man, you're pretty smart. Who'd you learn from? Just kidding. What time was this? This was around 10:15 Central. Let's take a look at this guy. And you could see, oh boy. And of course, I got to rewind it. So take a look at all this red that it stops and just chisels through, correct? And then you got to go back to in here because it was the 3-4 area that was that area again that had come down to retest it. And it was in here that the market was able to get above some punch in the face type scenario. And let's play it and see what happens. There's one example, it's 4 even. There's one today where you guys are in the room where it goes red to green, where there was some selling that came in, we couldn't go down, and it actually turned green. It was like red-green. You'll see it. And I think it was this 10:15 trade. And you could sit here and hold hands until it happens. Right there. See it? Bottom right. Went red to green. If you're looking to buy this 3-4 area in any market, and you're looking to say when, it's like the deer is closer than it's ever been. It's showing itself. If you don't fire, then what are you out trying to hunt? You're going to miss some of these. But again, it's order flow of selling that comes in aggressively and the damn thing can't go down. And so we do rally from this, and we already know that. But watch in this instance of, they might chop around a little bit, but stay above there. And there were moments where it gets red again, can't go down. It gets red again, can't go down. Red right there. Couldn't go down. Let's speed this up a little bit. I know I like you guys, but it's been all night. Give me a second and I'll answer that. Kyle, good question. And I'll be honest, there's another instance in here. This particular move or this particular trade, I didn't hold on to it the whole way. Got in, screwed up the exit on this particular one, took a small winner, but didn't hold on because it chopped too much. And I didn't get back. Let me pause a second. And I didn't get back in when I went red to green again in here. So I caught it and I was in a good spot, but I didn't get back in when I should have because this then was the easier move back out of the chop. It's just that kind of day. Is the market, as soon as it starts to get above where sellers came in, it just has a better release to the upside, and it gives you more of an idea of when it should happen. And if it's not going and it starts to get below where buyers came in, it gives you the same idea of what should happen, and it's not. So someone asks me, where would you put in a stop? It's not always the same every particular trade. So in this particular trade, I don't want to take a loser that's below, let me roll this down, that's below wherever the latest swing low was. I still don't want to be in the market if it gets down there, but that's my ultimate first initial stop, Carl. And I don't use hard stops. That doesn't mean I'm advocating it. I don't put a sell stop in when I'm long or a buy stop in when I'm short. I just don't do it. I have the discipline to click out. But I know that the price is going to be a little below this guy. I don't want to take that as a loss, but that's my ultimate risk. What I try to do is get a little bit right away, a little more, and then one or two trades where I can get a 3-point runner on the last batch. But that's the way I trade. Now, there's some guys that are better just holding it for either their stop or their target. And that's why trading is so case by case. So my initial in this particular trade is number one, price, and then time. If it takes longer to go where I want it to go, chances are I'm not going to make much on it, even if I'm right. No, I don't leave a runner on every trade, only the ones that are working. Now, some guys are better off being mechanical, and that's why anybody who tries to trade exactly like someone else is going to be barking up the wrong tree, because it's going to be impossible to be exactly like that person. You want an idea, there's similar styles, right? But it's like, if I'm in that particular trade, maybe I take a tick or two. I don't want to scalp, but if I'm not getting it to go where I want to go, then I will. But I got to have that market move, and I'm looking for less of a runner on a day like today, where it was a 5 or 6 point first hour and a half range. Now let's stop this a second. Later today, now this is the whole day, and we finally break out. We know it already breaks out, and we get a lot of green areas where it pushes up fast. And it's like, when it's already looking at a chart and it's trended up, you're just like, well, where can I have bought it? And it's easier to just go back, and it's hindsight's 2020. So you want to be able to say, if I think this market has upside, because you already seen it, but if when you go back to work on your ability to read the market, you have to say, if I bought pullbacks because I was bullish, where can I do it? Where could I get out? And why would I get in here other than it went green because it went fast in here? You following? So then it becomes a skill not just a skill to get support, but a skill to trade support. If you look at, well, let's stop this. Let's go to real time here. All right, this is up to the close. If you go into here and just look back at, I'm not going to do a replay, but just go back and look at, what time was this? Just before 3 o'clock, where you had a pullback to support. These supports never came into play. But if you're looking to get long, do you find any instance where sellers came in and the damn thing couldn't go down? And you come down in here, and it's not like, it's easy. Just, you come down in here, here's your test, buy it above here. Nothing's easy, but it does give you a sense of, hey, this is what should happen. If it doesn't, maybe I'm wrong below here. Maybe I'm wrong below my green level, and that's my initial risk. But what should happen is, after it gets above where there was a flurry of selling, I think that it's a punch in the face moment. And now you're reading order flow without having to analyze a bunch of numbers on the dome, a bunch of numbers on the footprint, but you're actually following the market and watching what should happen versus what is not happening, but it should. Always ask yourself, you have to know. I'll give you another example of what should happen but doesn't. If you get a really bullish economic number, and it's a big number, and the S&Ps rally, right? And they rally like this, and they started right there, bullish number, big number, market loves it, and within 5 minutes, it takes back the entire rally, comes up, and 15 minutes later, it's below where it started. What's that showing you? The market is not doing what it's supposed to do. Yeah, it did it initially, but why did it come all the way back? Why? Now you're starting to ask the right questions at the right time. Prop firm owner told me that within a couple months. If the market was so strong, why isn't it up? The market was so strong after the bonds rallied. He was talking about the bond. The bond and the bonds would move in the same direction. He says, if the market was so strong, why couldn't it hold on to this rally from here? Why is it down here when the bonds are higher? Why is it when the bonds go up, the bond can't go up, he'd say. It should go up, shouldn't it? Yeah. It's getting people stuck wrong. Someone's bigger than us absorbing a bunch of buyers, and those buyers got to turn to sellers, and that's what's going to send this market down. That's what creates weakness. And what's nice about the edge zones is that you could tweak the imbalance percentage. You could tweak what the total number would be in order to throw a green or red line. All right. And so the rule of thumb is you don't want too many or too few lines on your chart. Too many lines, it's too noisy. A lot of times when it's a slow day, you get that. But you got to tweak it. I don't tweak it a lot. You don't have to once you get the right numbers. A couple things before we go. I told you I'd tell you what changes the color. If we go back to this morning, we had a green level come in. Forget about these oranges for a second. But green came in. If it gets tested once like it did in here, it goes dark green to light green. If it gets tested twice like it did in here, and that was the second example I showed you guys. Right here, it goes green, light green to orange. Dark green to light green for one test, after two tests, orange. It's counting the tests for you. Because after so many tests, you don't want to keep playing it. It's counting how many tests that this market went to your level. And it could change if you want it. And that's something you could set or not set. But so that's what it's doing. Same thing, red to pink. How many times did it get tested? Also remember this, because I didn't cover this in this webinar. It wasn't part of it. Every footprint you look at or bar or anything else, you have to read in a rotational sense. The story I tell is a bird in the sky. If it left a trail, what would it look like? Because that's what we're doing. We're following it. So just look at this. Now, this was a crap tight range day, right? Held the bottom of the range really nice. Okay, holds the top here, holds this red really nice. When it gets through, it follows through, holds this red, comes down, holds this green, holds this red, comes in here, shows a couple tests, holds it in there, comes down, holds it down here again, holds all these reds for some chop, comes down, throws in this green, holds it, throws in all this green, holds it, comes up as soon as it gets through this red, shows you follow through, green doesn't get tested, green doesn't get tested, green doesn't get tested, holds, goes up, sets up this red, holds it once. It was a strong day, comes in here, stuck short or stuck selling, goes up green, gets through this red, turns it green, uses it as support, runs up, comes down, still uses the green as support and closes. That was today. I'm not showing you guys images of days that work really well. Show you today and get a sense of how they do and how they can help. So it has to be, support resistance have to have some semblance of order flow and trap traders, because that's the definition of why support would work. What makes great support great? Stuck shorts. All of them. Question is, what chart am I primarily watching? This is the room. And so this, and by the way, this isn't a system that I'm telling people to trade. This is how to from a discretionary standpoint, how to read the market, find good levels, find good execution. There's other things that could get me bullish than a line in the sand. But I'm looking at all these. Forget about these dials for a second. That's not what this is about. But just look at, this is the S&P, this is the NASDAQ, this is the Dow, this is the crude oil. And then this is the footprint for the punch in the face type moments. There's a heat map over here. That's just one of my screens. You got to remember, I've been doing this a long time, and so people need either to be around others that have eyes and ears on what matters. I'm not saying everybody belongs in a room and everybody belongs with somewhat, but everybody should be around people with eyes and ears on what matters. If all you have is a bunch of guys with eyes and ears on profile, you're missing a whole bunch of stuff. You got to have guys with eyes and ears on ancillary markets, good levels. A lot of selling can't go down. A lot of buying can't go up. Yen just got hit. Look at the bonds. They've been working great opposite. If you're bullish, a good spot to get long. If you're bullish, we should stay above this moment. If it's not, it's a transitional moment to the down. All real-time analysis based on compare, contrast, and flow. Russell was strong this morning. If you were trying to sell the S&P, the thorn in your side was the Russell because it was so damn parabolic and strong, and the small caps eventually let everything else up. I don't, but people do. So Milan asks, using this trading style from a higher time frame. Yes, a lot of people use it. Then we get into investing, which is more monthly, but weekly and daily, people are looking at longer time frames. But support is support no matter what time you look at it, no time frame you look at it. No matter how long you hold on to a trade, you got to get in and out real time, and there's the definition of good location no matter what your time frame is. The difference between shorter time frame and longer time frame is just that. How long you expect to hold the trade because you're looking for more. You're risking more and looking for more when you're a longer time frame trader. But the idea of support resistance is always relevant no matter your time frame. You always want good locations. You give someone money for 30 years or 30 seconds. You still want to get paid. You just expect more the longer you give it to them, right? You expect more interest the longer you give. So you're going to take bigger risk because you want bigger reward. But good location gives you the staying power to get that runner if you're a shorter time frame trader. To stay in that investment or that swing trade for a couple weeks because your location was better. One of there's a lot of great things about market profile. How many people in your profile would say that they're decent or proficient in market or volume profiling? Give me a yes if you do. By the way, Kyle, these dials, I did another webinar on them. I don't sell them or anything else. I made them right now for myself just to get a good sense on what other markets are doing. That's all. So a lot of people are profilers. There's nothing wrong with it. I'd encourage people to study profile. The weakness in profiling is qualifying the opinion it gives you. So it gives you a good opinion. Hey, the market's bullish because it's outside value area. It's above the 3-day value area, all this other stuff. But when do you buy it? And after you buy it, am I taking too much heat? And you get stopped out and then it rallies. So you were right and you lost money. So every person who's a profiler agrees to that statement. It's great, but its weakness is qualifying the trade, not taking too much heat on your bullish trades, having a good spot to qualify value area high. You know, I miss it. One thing I want people to look at when you're profiling is take a popular profile setup, and when it stops, when you see it not working, do the opposite. Don't do profile stuff that's popular. Do the opposite when you can tell it's not working. Because, you know, you got a lot of people stuck. If a lot of profilers are long, then there's a lot of sellers in the market. I don't know about you, but if indeed there's a lot of sellers in the market, I don't want to be long. I don't want that product. There's one thing else I'm leaving. Oh, here it is. Let me show you this real quick. Oh, I forgot to record. No, I did. I'm just joking. What's next? What do I mean, what's next? If you guys want this, I don't sell it. I don't want to be in the software business. So I had this developed, and guy who developed it, super responsive guy. I've had it on Sierra for over a year now, and it works. That's what I like. I just want it to work. He's putting it on NinjaTrader 8 later this month. So what's next? If you want it, first step, there's a link in the chat that I'm going to put in there. Well, if you're watching this on YouTube, I'll put it in the description section. So if you guys here live, I'll put a link in the chat. Go to it and take a trial for it. Also, if you don't have Sierra, you could take a trial to that, do one in both. If you have Sierra, you could just do the add-on. If not, you could do both. And if you're doing it, no, I never traded. Hold on, I'll get in that in a second, Kyle. Get my layout for Sierra. Like the layout I just showed you on my screen, people that go and do this, I'll send it to you so you have a good starting point. And then get him for a month or two. And you're going to do it through him. He supports it and everything else. I'm just happy that he put these together, made them work, and then put yourself into, make sure you get my layout, because it's a pain sometimes to change software if that's what you're doing, but it's not a pain if you have a good starting point. And Sierra is one of the few things in any industry you get more for less. They got profile stuff, they got heat map stuff, and they got footprint stuff. But here's what's key. Better locations does a few things. Number one, when you have better locations, all of a sudden it becomes easier to manage your risk and to know where to put your stops. Like someone, I always get asked where you put your stop, where you put your stop. It's easier with stop placement when your locations are consistent. It's easier to manage your risk, manage your reward. It allows you to be wrong and make money or not lose money. See, if you're wrong and you get killed every time, you're going to be gun shy the next trade, the next day. But if you're wrong, not necessarily going to make money every time you're wrong, but if you don't get killed every time you're wrong, you got less scar tissue for the next trade because you know what to do when you're wrong. It's all about good locations. Better locations make a lot of things easier, and it helps you stop missing your stuff. A lot of people will come to me and say they miss a lot of winners and catch all the losers. The layouts could change based on product, but you could change that, Christian. Good question. You could change the settings for it and tweak them. And the settings that I like are in each market, but you could always tweak them. And the key is not to have too many lines for any support resistance or too few lines. But I have additional products in the layout. Oil, NASDAQ, Dow. I'll throw a gold one in there. S&P, of course. No, Wes, I can't. Do you have Sierra? I sent you a chat, Wes. Oh, I got to post a link. Thanks, Kyle. You're on the ball. If I had a prize, Kyle, you'd get it. What is it we got to get a link to? The Sierra 7-day trial. Sit tight. We're going to get that. Anybody else got questions? Pop them in there and we'll roll through them. I'll keep the recording going. We're looking for... And if you're watching this on YouTube in the future, I'll put it in the description. All right, Wes, give me an email, though. You guys got my email address, Anthony at Edge Trading Group. There is the link. Make sure. Christian, what are you showing me? Now use this one that I sent. If you don't have Sierra, you could use that link to get a trial for Sierra. If you already have it, you just want the edge zones, you can do that through this link as well. Joseph, what's a good trade or imbalance ratio? 987. No, Kyle. The zones just include the zones. Just include the add-on and all the support and everything around it. Lee over there will take care of it. The Edge Pro is something totally different. That's the trading room and some other education. You guys got the link? You should have it. What else did I want to give you? Oh, the link in the description page I'll do after I upload it to YouTube for you guys watching in the future. There you go, Kyle. Exactly. Edge Pro is a subscription to some education, goes a little deeper than the webinars I have out there, than the daily room, weekly sessions I have. I bring in guests to come in, but not the indicator, just the screen share. This is a add-on that's totally separate. End of the month, Gary. Oh, that's what I want to give you. For you guys that want Ninja, I got a page for you there. Gary, you're on the ball. Give me a second. Let me post that. Oh, that's why I had it already right there. Right in front of me. If it was a dog, it would have bit me. You guys are on NinjaTrader 8 and you want to get set for that, click that link. Pre-registration that Lee at Emoji will take care of. Fill out that. You'll be the first ones to try that in a week. Sierra's already been working for a better part of a year. That was the first link I sent in there. If you don't have Sierra, you could take a trial with it, John. If you have Sierra, you could just add on the edge indicator or the edge zone add-on. It's a lot cheaper, probably. There's stack buying you could show. You could also show a lot of like double or triple. It only shows double imbalances and triple imbalances. No, I don't. I wouldn't say that. So Kyle's asking me, all right, Brian, is there a market I think works best with these zones? Listen, a market's a market. So the whole concept of stuck traders, tempo picking up, why this would work, and that's why again when people get into this proprietary stuff, it's not when people have this mysterious proprietary indicator, they just do that to market it. Right? There's nothing. What's important about a good level is how to use it. You know what I mean? Why is it a level? Does it have to do with the concept, the dynamic of stuck traders? Because it needs to. I mean, that's what support is. One thing I didn't say that I wanted to say is that of all the people I've worked with, trained, spoke to on the phone over the last 20 years, the common denominator is everybody has levels. Right? Support resistance. I think everybody they come out of the wound with levels. They're born, doctor slaps them, and they all got support resistance levels. How you get them, there's differences. That doesn't mean mine's better than yours, but the skill comes from, let me draw it up. The skill comes from, do you have the skill to overlap the qualifier? Yeah, there are better support areas than others. But what the definition of support, when it works, is you had enough people trapped long. When you have, trapped short. And you got to know it like it's the back of your hand. When people are short, they're buyers, and buyers that are trapped in a certain area create a support area. People who are stuck long are sellers, and that creates resistance. You need sellers, and when you have sellers at resistance, for resistance to work, you need sellers. But when you have sellers that have to sell it, they're more emotional. If I want to sell something because I might want to get short, maybe I'll sell it. I'm not really that worried if I miss it, maybe. But if I have to sell it, am I not more emotional? And people who are long have to sell it. So the best levels that work effortlessly is that you caught that dynamic all coming together. So if you take nothing else from this webinar, and you get these zones or not, you'll understand why good support and good resistance would work. I think everybody should get that. From all the webinars I've done, and I've been putting stuff out there for 8 or 9 years, you can go back and look at something I originally did. Concepts, when they're the right concepts, should never change. All right, Kyle. The separator is always how to use them. And so you get people in this industry that I created that first, and I had this, and I had that, and then I did webinars years ago that actually shows it or has it, and shows the different imbalances, and then people put the key to anything is, why do they support resistance? Everybody else, they all hack at each other. They duplicate this and they copy that. It's all BS. All that matters is how to use it, why to use it, when to use it. That's where the skill is. And that's where people, they finally get around to giving themselves the best chance to do this. It's because they found the people in the back of the store. They didn't find the guys in the front, right? That they had all these blinking lights, and they showed them how easy trading is. The stuff that's going to give anybody a better chance to do this consistently, the ones that survive through all that BS and get to the people in the back of the store. Any other questions we got? And plus, here's the other thing with any kind of stuff that you buy that are add-ons. It's really important. Responsiveness. If someone gets back to you, it ain't about the problem, it's about the solution. So if there's ever like an issue or anything, I found Lee to be one of the most responsive guys in the business. And that's the key. When you get people that never get back to you for days or weeks, and they got your email, meaning it's not like it went to spam or whatever, they're not really there to help you. Who else got questions? Is that it? We've got the links, right? You got the link if you want Sierra. You got the link if you want to register for NinjaTrader 8. Not 7, just 8. I might have said 7 in some promotional stuff. It's just 8. And you don't want to be on NinjaTrader 7, I think, anyways. Right. Email me, Anthony at edgetradinggroup.com, when and if you're going to get want to request my layout with your Sierra account name. But we'll get into that afterwards. All right. Did you go through that link? I think a lot of people are getting better when the micros came out. Would you guys agree? Let me stop the recording because that pretty much ends it for this. So I'll put the links for you YouTube guys in the description page. I'll keep this webinar open for you guys who got questions. In the meantime, I'll stop the recording.